The biggest tax mistakes high-income earners make aren't the ones you're probably thinking about. The secret is not about finding some secret tax loophole or some offshore haven that will magically make your tax bill disappear. As much as I would like to sit here and say that, and trust me, that would make what we do a lot easier, it's just simply not the truth. My name is Omar Murillo. I am founder of Imperio Wealth Advisors, and I am a certified financial planner practitioner. The reality is, to reduce your tax liability in the current or future years, you need some fundamentals in place which most high-earning entrepreneurs and professionals that we talk to just don't have. So in this video, I'm going to take you through 3 of the biggest tax mistakes I believe high earners make and strategies that may help so that by the end of this video, you know exactly what's costing you thousands and how to potentially stop the bleeding. The first mistake is focusing on income instead of wealth. Why this happens? In my opinion, most high earners are trained to maximize their income, not their wealth. Tax planning for many high earners is a reactive instead of a proactive strategy. And some traditional CPAs are historians, not forward-looking strategists. Now, if we discuss the hypothetical financial impact that this can have, imagine a medical practice owner overpaying by $300,000 or more in unnecessary taxes due to lack of proactive tax planning. The opportunity cost of that money lost to taxes that could instead be building wealth over a 10-year period, assuming all things and income and tax burden stay the same, still equates to more than $3 million that went to taxes unnecessarily at the base level. Now, if you compound that effect over a career lifetime, imagine that extrapolated over a 25-year career, you're talking $7.5 million without factoring the opportunity cost of not having that wealth working for you. So how do we fix that? We shift our mindset from income maximization to wealth maximization and implement year-round tax strategy and planning, not just filing tax tactics at the last minute. Instead of looking at income streams linearly, we structure them strategically to help optimize the tax treatment. The second mistake is neglecting advanced retirement planning strategies. Why does this happen? Because most people think that a simple 401k contribution is enough. They don't take the time to understand more advanced plans such as cash balance and defined benefit options. And they're focusing only on current income needs and not also bearing in mind the future tax environment. So hypothetically speaking, a dental professional could save north of $150,000 a year if they do proper planning. Let's assume that they have an income north of $1 million and are at the highest federal tax bracket of 37%. With a 401k plan under the current contribution limits and combining it with an advanced retirement plan like a pension, we could potentially help reduce their current tax bill by just north of $150,000, and that savings could be applied every single year, assuming that the same planning is done. And of course, if they live in a state with income taxes, the savings could be greater. So long-term tax deferred growth potential is lost if proper planning isn't done. And under the assumptions of the case study that we just went over, the hypothetical case study that we just reviewed, that could be more than $1.5 million compounding for their benefit over a 10-year period inside their tax deferred qualified plan that would have otherwise gone to taxes. So how do we fix this? If you're a business owner or derive a large portion of your income via 1099, we can explore whether implementing a cash balance pension plan alongside a 401k makes sense. We can utilize strategic Roth conversion ladders whenever appropriate as part of the overall wealth planning. We can structure retirement contributions for maximum tax advantage. The third mistake is missing entity structure and business expense opportunity. Why this happens? Because entrepreneurs sometimes choose to operate under improper business structures due to not understanding what options are available to them. They also sometimes miss opportunities to optimize legitimate business expenses, and they also at times fail to implement family income splitting strategies. The financial impact of this can be displayed in this hypothetical case study. A business owner saves $85,000 with proper entity structure. Instead of simply receiving a 1099, filing under Schedule C, an entrepreneur might consider creating an LLC that files as an S corp, and that will enable them to deduct the ordinary and necessary business expenses related to running that entity. This may also open the door to the establishment of off tax-deductible retirement contributions along with the current qualified business income QBI deduction, which shields the first 20% of income from taxes at the federal level. Now, if the documentation for the business expenses isn't done properly, then there are some hidden costs of audit risk, because when not properly documented and justified, deductions may be disallowed by the IRS. So proper planning and consultation with your tax professionals is key. However, missed deductions that add up to 6 figures annually, missing out on the QBI exemption, along with opportunities to fund tax-deductible retirement benefits, could add up to missed 6-figure tax savings when you're a top earner in your field. So if we extrapolate that $85,000 savings over a 10-year period, that's $850,000 that would have gone to taxes that instead you would hypothetically be keeping working in your balance sheet. So how do you fix this? You want to have strategic entity structuring for your specific situation. And that means that when this is done, you're going to implement proper documentation systems for expenses. And as far as family employment strategies, where appropriate, meaning you hire your children, you hire your spouse in order to reduce your taxable income, caution must be exercised, and you should consult with your tax professional to avoid violating IRS guidelines and avoid a scenario in which your deductions are disallowed. Using the business enterprise approach to your personal wealth management is key. And what I mean by that is many entrepreneurs fail to give their wealth management strategy the same level of thought and attention that they so meticulously dedicate to their businesses, when in my opinion, it shouldn't be any different. So there you have it. Those are the 3 biggest tax mistakes high earners make that could cost them a lot of money every year. If you implement just one of these fixes we've discussed, you might see significant tax savings. The truth is, most high-income entrepreneurs and professionals aren't thinking strategically about their taxes because they're too busy running their businesses and serving their clients. And that's exactly why they continue to overpay. We've been helping business owners and medical professionals optimize their tax strategies for years. So if you're making north of $500,000 a year and want a strategic partner to help you legitimately save on taxes, click the link in the description to book a strategy call with me and my team. We'll discuss and look at your current situation and show you how much you could be saving with a specific tax strategy in place tailored to meet your needs. Thanks for watching. And remember, it's not about how much you make, it's about how much you keep. And for actual wealth planning from an actual certified financial planner professional, subscribe. I'll see you in the next video.